Howdy, Jacob here. Today we're looking at Fastenal Company, number 40 of our high ROIC screener with a $41.8 billion market cap, essentially the same enterprise value. Looks like they engage in wholesale distribution of industrial and construction supplies in the US and Canada, headquartered in Winona, Sonoma, AO, founded in 1967. Okay, revenue growth is almost double from 10 years ago. On the earnings per share side, over double. Return on invested capital is greater and is actually 30% right now. So absolutely astounding return on the money that's reinvested back in the business. Let's see if they actually do some reinvestment. Okay, so funny that their capital expenditures are lower than 10 years ago, and their cash from operations is almost triple. So that's very impressive. Their use of cash is, oh man, they're paying out a dividend. Okay, so I don't want them to be paying out such a high dividend with the power of their reinvestment being so high. Obviously, companies get so big that they don't have those opportunities to invest in. But if an opportunity were to arise, you don't want them to go into debt to fund that. You want cash on hand or short-term investments to be able to really pound out and get that massive return that you've done historically. And here we're saying that they're paying out $1 billion of their cash flow in a dividend, and that's on a 5-year average basis. I mean, that's 100%. But on even the rolling 12, we're looking at 75, 80%. We don't want that for this type of company. I would want them to be reinvesting back in themselves, whether that be through straight up purchasing equipment that can keep the flow going, whatever type of bit. I mean, it depends on what type of business it is, but invest through capital expenditures essentially, or through acquisitions that make you more efficient. Buy back shares that are extremely cheap. It looks like they've bought back a little bit of shares in the last 10 years. Maybe they've used 5 to 10% of their free cash flow to buy back shares, and then more recently paid down some debt. But yeah, I want this company to be reinvesting as much as possible. Let's start with some assumptions. I would say that growth rate probably close to 7%. Let's get 18 on the P and price of free cash flow. I also don't like that their free cash flow margin is greater than their earnings margin. Let's do pretty much in line with averages here, because the gross margin is actually down 5% and operating margin is essentially the same. So I'm just doing the exact same as history here. And then share change, let's just do flat. Dividend, they want to increase this dividend. I want them to keep it the same. So they're already paying out 70, 75%. A growth company, can they afford this? If that's the question, then absolutely. But I don't want them to be paying it. And so I'm going to meet in the middle and say, hey, just keep it the same. With that excess cash flow as you make beyond it, from now on, just start reinvesting it like crazy. And I mean, I'm comfortable with all these assumptions. The only thing I could see somebody have a different, revenue growth, I guess, maybe a little bit, but the terminal PE, again, I'm just a more value individual where I want to buy companies for not only reasonable valuations, but very cheap valuations. And to me right now, it's just looking a bit expensive with the prospective growth I see for them and the future margins that I see for them. So hopefully enjoy the video and have a great rest of your day. Thank you.